Hello everyone, and welcome to our webinar today entitled Grow Your Lending Portfolio, Manufactured Housing Loans. Thanks for joining us. My name is Alex Gregg and I'm the Content Marketing Manager for NAFCU Services. Our webinar today is presented by Triad Financial Services, our preferred partner for indirect consumer lending. We have just a couple details to note before we begin. The first is we are recording this presentation. So following the webinar, a link to the recording and a PDF of the presentation slides will be emailed to you. We will also post these items on the Triad page of the NAFCU website. Please use the panel on your screen to submit questions at any point during the presentation. We will answer several questions during the Q&A portion today. However, if we don't cover every question, Triad will respond after the webinar. I am pleased to introduce our expert presenter today, Keith Stayer. Keith is the Senior Vice President of Lender Development at Triad Financial Services. Keith's responsibilities include assisting credit unions grow and diversify their loan portfolios while expanding membership. He has over 25 years of experience in finance and has held leadership positions with Synovus Financial, NetBank, RBMG, and Merrill Lynch Credit Corporation. He has a broad background in commercial lending, mortgage banking, consumer finance, and loan portfolio management. Keith's a graduate of the University of Florida. Keith is a great friend to the credit union community, and we're glad to have him with us today. So with that, I welcome Keith to our webinar. Keith?
Great. Thank you very much, Alex, for your introduction, and thank you for everybody for coming into the webinar. As Alex said, I'm a Senior Vice President in charge of Lender Development and Retention, and my responsibilities include working with credit unions to grow and diversify their loan portfolio. So just a little bit of background about Triad Financial Services, who we are, and then go into why manufactured housing lending can be a very valuable asset for your loan portfolio. Triad Financial Services is a specialty finance company. We've been around since 1959. Our headquarters is in Jacksonville, Florida, with offices just outside of Chicago, Illinois, Wichita, Kansas, and our West Coast divisions is based out of Irvine, California. And who we are, we're the nation's top lender for manufactured homes for prime, well-qualified buyers only. So we're prime credit specialists, and we're currently servicing over $1.3 billion in outstanding manufactured housing loans with over 125 lending partners, and those lending partners being banks and credit unions, and we offer financing programs in 42 states. So a question when we originally speak with credit unions or financial institutions is really, what is today's manufactured housing? So today we'll talk a little bit about manufactured housing as well as the advantages of manufactured housing. We'll take a quick snapshot of what the industry looks like, and we'll hopefully address any perceptions that people have regarding manufactured housing, as well as what financing options are available for borrowers who are seeking to purchase a manufactured home. We'll also take a quick look at what the CFPB regulations, the recent CFPB regulations that were implemented and how they affect originations of manufactured housing loans. And really we'll conclude by how manufactured housing finance can help grow and diversify your credit union's loan portfolio. So what is manufactured homes? Or quite simply, factory-built homes that are built according to strict HUD standards. They have a very distinctive business model. These homes are built indoors in a climate-controlled setting. They're built by very seasoned professionals and craftsmen, and these construction adheres to very strict QC standards at the factory and through HUD. These homes are typically purchased through a retailer network, and then they are constructed in a factory, and they are completed and delivered and installed by professionals. But another way to look at manufactured housing and factory-built homes, which I observed at a recent plant visit, is really homes are built from the inside out, meaning that these homes, the foundation is delivered first within the factory, and then from the foundations the walls are erected, the closets are built, the cabinets, the countertops are built, and really one of the last items that go on are the roof. So it's almost a complete opposite of what a site-built single-family home is, how they are built. So what are some of the biggest advantages of manufactured housing? More so is the cost. The new construction cost per square foot is considerably less than site-built homes, And part of the reasons for that cost advantage is all the construction materials as well as all the interior appliances and finishes are purchased in volume by the factory, which provides significant savings which are passed on to the consumer. A misperception is manufactured homes do not appreciate like site-built homes, but we have found that they do appreciate a site-built home very much like site-built homes because of the affordability and as well as the quality of the construction. Another way to compare a manufactured home versus a site-built home is if you look at the average sales price for a manufactured home in 2014, the average sales price is $65,300 and the average square foot is $1,438 or $45.41 per square foot. Compare that to the average sales price of a site-built home of $261,000 or 2,690 square foot, you'll see that the cost per square foot is $97.10. It's almost a double the savings for purchasing a factory-built or manufactured home versus a site-built home. The advantages in quality. Also, when you're building a manufacturer or factory-built home, the QC oversight is continuous with multiple layers of oversight administered by HUD. And all of the aspects of the construction process are controlled because the weather does not interfere with any construction timing. Unlike a site-built home, if you're delivering materials to a site and there is any type of weather delays, that materials will frequently sit on the site until that process is able to take place due to weather delays. So for factory-built housing, you do not have these type of weather delays. And all the technicians, craftsmen, assemblers, they work as a team. They're all professionally supervised. And the typical time frame it takes for a plant to construct a home is approximately 5 days. And a typical plant will produce anywhere from 5 to 6 homes per day. Another point is that they're very eco-conscious and efficiently built, meaning that there's minimal waste and recycling, what makes the factory inherently green. But even more so is these factories are able to leverage technology, in many cases robotics, in order to construct a home which significantly reduces the waste, thereby reducing cost. Personally, I've observed a 1,700 square foot home being constructed in a factory, and by the time it was ready to be shipped, the waste as a result of the home fit into a small garbage can. So they have a very efficient way by leveraging technology to build these homes in order to keep the price low. Other advantages in quality, there's multiple amenities to choose from, which range from very basic to very elaborate, really depending on what the borrower or the buyer's preferences are. There's awnings, there's patio covers, there's decks, site-built garages, and permanent foundations are available for upgrades. Of course, there's other upgrades available such as granite countertops, drop lighting, oak cabinets, etc. So it's really up to whatever the home buyer's preferences are. Also the safety standards, that these homes are engineered for wind safety and energy efficiency based on the geographic region which they are sold. So for example, in the state of Florida, they're built to very, very strict hurricane force wind standards, in some cases exceeding site-built homes. So really manufactured homes are among the safest housing choices available due to the strict federal laws administered by HUD for the construction of these homes. So if you look at some of the industry data, right now there's 37 corporations producing homes in 122 plants throughout the United States. 53% of these homes are multi-sectional plans, whereas 47% of the homes are considered single-wide or double-wide section plans. And nearly 12% of all new single-family homes sold in 2015 are factory-built or manufactured homes. 67% of these homes produced are placed on private land, whereas 33% are placed in communities. If you look at the geographic regions as to where these homes are not just built but where they are shipped, you'll see certain areas throughout the country having higher concentration levels of factory-built homes than others. The highest being the West-South region, or the Texas, Louisiana, Arkansas, consistently has the highest concentration of factory-built or manufactured homes in that area, followed by the South and the South Atlantic. So really, if you look at Triad Financial Services and where we originate loans from, the concentration levels are very consistent with the previous slide. Most of our business is in the Texas area. Most of it's in the Southwest region, with heavy degrees of concentration in the Southeast markets. So the opportunity for credit unions is certainly, if you're a credit union within this geographic footprint, there are significant opportunities to grow and diversify your loan portfolio with this asset class. So geographic diversification is one thing to keep in mind when you're considering growing your loan portfolio with manufactured housing. Unfortunately, in the past, there's always been myths or perceptions for manufactured housing. And quite honestly, quite a bit of it is from media-fed type images. One of the perceptions are these homes are poorly constructed trailers, that these homes do not appreciate in value, or they're undesirable trailer parks. That there's a perception that all of these homes have axles and wheels and that can be moved at any time. And these loans have high delinquency and default rates because these borrowers typically have lower credit scores. What we have found in over 50 years of originating manufactured housing loans, this is a battle that we're constantly fighting because the perception is not reality. Some of the homes that there are homes that are out there pre-1976, pre-HUD codes that are not new construction, such as this particular home, that is not a type of home that we would finance and as many finance companies would not finance. You can see that this is not properly affixed to a foundation. This is a trailer, for lack of a better word, but this is not the type of collateral that Triad would originate, nor is produced by today's factory. This is another home. The perception is that these homes are always built in some remote area with minimal amenities and poorly constructed homes. Again, this is not the type of collateral that is out there in today's manufactured homes. The reality is that Triad and other finance companies finance new homes. This is a new multi-sectional home which was constructed into a factory, delivered and permanently affixed to a foundation. And over 70% of the homes that we originate loans on are new construction. And most look like this. This is a home that was built, delivered on a flatbed, assembled at the site, where the amenities include the porch, the sidewalk, the landscaping. And this is a home that is a very affordable housing option for the customer. So who lives in these homes? Who are some of the manufactured home owners? The borrower profiles are typically gray-collared workers. These are your firefighters. These are your police officers, your city workers, your teachers. Or there are retirees who are seeking a cost-effective, high-quality housing option, which are typically in an age-restricted, well-maintained community. Or else these are private landowners who prefer the privacy and flexibility that comes with manufactured home ownership. Or even these are professionals in your communities that live in high-cost areas where traditional site-built homes are not affordable. And I put the example as California, which has very high property values, but manufactured housing finance is a key component because of that, because of their affordability when compared to site-built homes. But if you look at this slide and you look at who lives in these manufactured homes, these are your members. These are credit union members. These are people who are members of your credit union who take advantage of other products and services that your credit union offers. So something to keep in mind is who are the profiles and who lives in these homes. But further demographics, without getting too deep into this slide, as you'll see, over 70% of the residents are between the ages of 18 and 59. If you look at some of the trends in the financing market and the history of manufactured housing finance, that what happened in the late 1990s and the early 2000s is really the overly aggressive underwriting standards, meaning that companies were originating loans and to people who did not qualify. And quite honestly, Unfortunately, we did that again later in the 2000s with the site-built home market, but the overly aggressive underwriting standards contributed in the late 1990s and drove the industry decline. With that industry decline, there was a lack of a securitization markets with limited liquidity and the number of finance companies able to offer loans on manufactured homes. Certainly some small community banks and some credit unions will originate manufactured housing loans on a case-by-case basis, but it's a very specialized program, and I'll get into what the product mix looks like, and it's helpful to have a partner who has that expertise and knows what they're doing when they're originating manufactured housing loans. Certainly VA and FHA loans are available through certain lenders, but really there's a limited financing options that are concentrated amongst a handful of specialty finance companies. But as the GSEs evaluates ways to support affordable housing, it's very likely that more lenders will start to enter this market as the GSEs become more acceptance and realize that as part of their duty to serve, they need to support this asset. And just a graph to illustrate where the industry decline happened. Again, it was the late 1990s, the underwriting standards, which led into the 2000 shipments being declined because there was just not any buyers and other finance companies, and the market just started to dry up. You'll see that in January 2000, you'll see a peak shipments of just under 300,000 shipments per year. That means that homes that are built in the factory and shipped, so that shipment went from a little less than 300,000, dipped all the way down in November 2010. But what you're seeing now is during that time, a lot of the finance companies that had the overly aggressive underwriting guidelines that were originate loans without carefully evaluating the borrower's ability to repay, they've left the industry. So now you're having the players that know what they're doing and know how to do the business. They're starting to see a gradual uptick in shipments, which if this slide by the Census Bureau goes through March of 2015, but through September 2015, you'll see the shipments actually are starting to approach 80,000 units per year. So the trend line continues. But the key being is hopefully, well, the key being that a lot of the players who contributed to the demise are no longer in this business. If you look at some of the finance programs that are out there, most of what you'll see is what's called a chattel loan. These are homes that can be financed as a personal property on leased land in a manufactured home community or on privately owned on site. A chattel loan from an asset class standpoint within your credit union is considered a consumer personal property loan because you're not encumbering the underlying real estate. It's just a home only is what your collateral is. The borrower does not own the underlying real estate. They would either typically pay rent to a community owner, or if it's on private land, they'll pay rent to that landowner. So financing that it's a title, it's not a mortgage. Other programs are land home loans. You have a Land Plus program, whereas homes the loan is originated using the underlying collateral, the underlying land as collateral in lieu of a cash down payment. But you also have a real estate transaction, which is subject to all the TRID guidelines, and you have that asset class in your credit union as well. So from an asset class standpoint, you have three programs, a land home, which is real estate. You have what's called a Land Plus loan, as well as a chattel loan. So there's multiple types of financing available, but mostly what you'll see within the industry today is a chattel loan or personal property consumer loan. Some of the loan terms, your typical loan terms for manufactured home loans on the newer homes or the new homes, you'll see anywhere from 10 to 20% plus cash down payment from the borrowers. So it's nice that the borrowers do have equity in the transaction. You'll see terms anywhere from 15 to 30 years depending on the credit profile and the collateral type. Under the existing homes, you'll see it's very similar down payment and 10 to 20% plus. In terms up to 20 years. For what we see in our transaction for Triad is our average term is about 225 months but these loans typically pay off on the portfolio on approximately 84 months. And our average down payment is 18%. So the loans can be perform exceptionally well if they are underwritten properly, because the borrower does have some equity in the game, and these are underwritten according to guidelines. A couple of the CFPB regulations that impacted our business, and there's several, but I'll talk about a couple of them. The first being the Steering and the SAFE Act, as well as the HPML, or High Price Mortgage Loan, evaluating the borrower's ability to repay according to Appendix Q of the CFPB, which makes it a qualified mortgage. The biggest impact on our business is the anti-steering rule, which really restricts the retailer from assisting the borrower into selecting a finance company. The SAFE Act requires the loan originator who is taking the application and discussing. It requires the person who is taking the application and discussing rates and fees. They need to be uniquely licensed as a licensed mortgage loan originator in an MLS system. And what happens is a lot of our retailers, when a customer goes on to a retailer's lot and they select a floor plan and they decide the price, the next question they'll ask the retailer is, who am I going to get to finance this home? The retailer is not allowed to direct that customer into a particular finance company, so really the customer is on their own to find the company that's going to finance their manufactured home, because there's a very limited number of companies out there who will finance a manufactured home. And typically these retailers are not licensed mortgage loan originators. They did not complete their 8 hours of SAFE Act training. They did not take the NMLS, nor should they. It's really not their business. But really the borrower needs more guidance as to who should they select to finance their home, because it's not as readily available as it would be if the customer is buying a site-built home. The next item is a higher price mortgage loans that are defined as loans that exceed the annual prime offered rate, or APOR, plus 1.5% margin, which changes weekly. And most of the manufactured housing loans do exceed that APOR plus 1.5%, so they're considered higher price mortgage loans as defined by Section 35, which is fine as long as they have escrow for taxes and insurance, and we don't originate any type of exotic type of programs. And according to Appendix Q of the CFPB, we need to underwrite according to certain underwriting factors. I won't read each one of these, but most everybody who is originating a credit in the past or currently, these are typical items that need to be properly verified and documented in order for it to become a qualified mortgage. The qualified mortgages, which began in January 2014, which provides certain legal protections for lenders who follow certain regulations according to the Dodd-Frank Wall Street Reform and Consumer Protection Act. So we have determined that the lender has analyzed all borrowers' ability to repay based on income, assets, and debts, that the maximum debt-to-income ratio will not exceed 43% of pre-tax income, and again, and the qualified mortgage must not have any risky or overpriced loan features like negative amortization, balloon payments, 40-year terms, or interest-only mortgages. All of the mortgages that Triad originates are considered qualified mortgages. Well, they are qualified mortgages based on our underwriting standards as well as evaluating the collateral. So we touched on a few things. We touched on what manufactured housing is, the advantages of manufactured housing. We talked a little bit about the industry we gave an industry overview. Hopefully touched on the perceptions of manufactured housing and the CFPB rules and regulations that impacted our ability to originate qualified mortgages. So how could your credit union participate in today's manufactured home market? You see that it is a growing type of industries with a limited number of specialty finance companies out there. So what I'd like to start with is a real case study that we had through Triad that we helped the credit union build their loan portfolio. And what we found that this credit union was finding it difficult to expand their membership while increasing revenue. The compliance cost was increasing, and a large percentage of their loan portfolio was low margin automobile loans that were paying off at an alarming rate. The CEO of this credit union tasked his management team to come up with recommendations to increase revenue while minimizing expense. So we all have those type of CEOs who have come up with that task, and this is what we have found that worked for our credit union partners. We realize that credit unions attend the same conferences, so this executive officer at a credit union heard about Triad from a colleague at another institution, and they contacted Triad for a presentation. And we have the referring party was actively participating in our program and recommended our innovative indirect lending program as an ideal way to originate high quality, higher yield loans with minimal effort and no FTE requirement. After the program presentation, the credit union began their due diligence process and presented their findings to the board, and the board recognized the value and authorized the institution to begin investing loans from Triad. And the credit union is currently an active participant in the program and finds the Triad portfolio geographically diverse, secure, and highly profitable, and they're also a reference for Triad to other credit unions. So because we're a specialty finance company and there's not a lot of manufactured homes originators out there that have the expertise, it's really a small reference window, whereas we work with credit unions who refer their colleagues to us. So what this does is that when you're partnering with a specialty finance company, it's imperative that that specialty finance company, and not just in manufactured housing lending, but any type of lending, that they need to have the expertise in all facets of their business. That they need to provide a proven turnkey business model and deliver so you can produce the best performing loans in the most efficient manner possible. And it's important to have cash reserves to back the collateral and certainly be with an industry partner that has over 50 years of experience. But I mentioned earlier a couple of times during the presentation about diversification. And diversification is critical when you're looking at this type of asset class. What we found is many of our credit union partners do a lot of indirect auto lending, pretty much all indirect auto lending, that these loans are very low margin loans and they burn off the portfolio very quickly. So the credit union continues to run in place while they're trying to replenish which has already run off their portfolio. So when you're looking at diversification, the key to our program is geographic diversification. And as your field of membership warrants, it allows you to enter other markets so you can take advantage of other areas that you are unable to capture business in, such as auto paper or whatever type of lending you do. When you're looking at the specific asset class, it's important to have diversification within that pricing. So what we do is that we price our loans based on a borrower's credit score, the term of the loan, and how much down payment they are putting in. So if a borrower has a lower credit score but is still considered prime, they have a longer term but a low down payment, that will generate a higher yield to the credit union than the other end of the spectrum, which is the prime, super prime credit borrower. So diversification and pricing is very important, as is geographic diversification, but I touched on the asset class diversification. These chattel loans are considered consumer personal property loans, but blending that in with real estate loans will provide even more diversification. And loan duration. These loans do not burn off like auto loan paper. The average life of loan lasts about on average 84 months. So they are a valuable asset to have on your books because of the duration of the loan, and not just that, but because of the yield that they produce. If you look at the credit union yields for auto paper, used and new, and other asset classes within the credit union, you'll see that a manufactured home loan can be anywhere from 400 to 500 basis points and yield higher than auto paper. So really, it's important to partner with somebody who knows their business and knows their programs. And if the loans are properly underwritten and properly placed, you'll look at the performance of the portfolio, which if you look at the delinquency rates and default rates, and if you look over a period of time, certainly in the 2007, 2008 range, the loans perform exceptionally well during the most trying economic times that we've had in recent history in the United States. And the reason is simple. These people bought the home that they can afford. These people have put cash down payment. These borrowers realized these borrowers years ago could have bought a site-built home for $500,000 of interest-only payments or option arms or whatever the program, but these people bought the home that they can afford, and in some cases these homes are more affordable than rent. So these these borrowers or these members are very responsible people. They maintain their credit score and they pay their bills. So these are good asset classes to have on your books. Now I'd like to, that concludes that part of the presentation, and would certainly like to open it up to any questions that anybody has.
That's great. Thank you so much, Keith, for a great presentation. Especially that last slide, the loan yield report, it really shows the opportunities that are there. So we are going to open it up for Q&A from the audience now. For all of you on the line, just type your questions into the chat panel on your screen. Even if we can't address all questions during the session, Triad will be sure to respond after the webinar. There were a couple that came in already. So the first one was from Jay. And his question is, are manufactured housing loans considered mortgage loans and thus subject to recent TRID requirements?
On the chattel loans, no. They are considered personal property loans. On the land home loan, on the real estate loans, then yes, they are considered real property, real estate loans, and subject to TRID requirements.
Great, thanks. Second question is from Eric, who asks, how do your manufactured housing borrowers then become credit union members?
Well, it depends on what the credit union's field of membership requirements are. But what we do is that when we receive a loan application from a retailer or from a customer, then what we do is that we present a snapshot of that loan to the credit union up front. If that loan meets your credit union's criteria, then we will process it, underwrite it, close it, and then at closing we will have the customer complete your membership application, and then we send the entire loan package to the credit union with the membership application, and then we'll even pay the credit union membership fee for the borrower, and then that's how they become a member of your credit union. So it really depends on what your field of membership requirements are.
Thanks, Keith. Next question is from Dan, who asks, are the Homes Triad finances modular homes or manufactured multi-wide homes? From the description and photos, it seems as though they're more modular in nature than manufactured. Can you clarify this?
Well, most of what we do are manufactured or HUD homes, and that's different from modular homes. But we also offer financing on modular homes. The modulars are built in a factory and delivered in sections and by a crane once it gets to the property, whereas a manufactured home, which is subject to HUD guidelines, is built in a factory and delivered on a flatbed and then assembled at site. So the answer is we do both, manufactured, which are HUD coded, or modular, which are according to local building codes.
Next question is from Becky. Are there certain areas in the country where you see the most opportunity to enter the MH market?
Yeah, in the Southwest regions throughout the country, specifically Texas, Arkansas, Louisiana, we see the highest degree of manufactured homes. But in the Southeast market and also but the Mid-Atlantic market, we're seeing a less increase or less concentration, but a very high level. So the answer to the question is Southwest markets, Southeast markets, and the Mid-Atlantic you'll see the most, and California has also become a very large market for us. But we do financing in 42 states, but those regions, Southwest, Atlantic, Southeast, and California are producing the highest.
Great. Next question is from Renee, who asks, how does the indirect lending program work? Does the credit union enroll local MH dealers in the program?
No, the credit union has nothing to do with the MH dealer. We have the relationship with the manufactured home dealer. We employ regional managers out in the field who contact manufactured home retailers and provide borrower-facing educational information to them for financing. So our relationship is with the manufactured home retailer, not the credit union.
All right, Keith. Well, thank you so much. That is all the time we have today, everyone. If your question wasn't addressed, we will be sure to respond directly after the webinar. Keith, thank you very much. It's always a pleasure. Many thanks to all of you who joined us today. We hope that you enjoyed the webinar, and we will send you a copy of the slides as well as a link to the recording. Hope to see you next time.
Thank you, Alex. Thank you, everybody.